It's 2026. You finally open the brokerage app everyone keeps pushing. The S&P 500 is sitting near fresh highs after a solid run the last few years. A friend just posted their portfolio up 22%. You transfer your first $300, buy the can't-miss AI stock that's all over your feed, and feel like you're finally in the game. 2 weeks later, the stock drops 19% overnight on some earnings miss. Your $300 is now $243. The app sends a cheerful stay the course notification. You sell anyway. And the quiet, uncomfortable truth lands like a punch. Most beginners don't lose money because the market is rigged against them. They lose because they treat investing like gambling and then panic when it behaves exactly like the market always has. Right now, the headlines paint a picture that feels almost too steady. Inflation has cooled to roughly 2.5%. Unemployment hovers near 4.2%. The Fed has rates parked around 4% after last year's cuts. The S&P 500 is showing modest gains year to date, but the longer trend still averages about 10% nominal returns historically, roughly 7% after inflation. On paper, it looks like a decent time to start, until you look at what actually happens to real beginners. The majority put money in, watch a dip, pull out, repeat. Their average holding period for stocks is measured in months, not decades. Meanwhile, the people who quietly get wealthy treat the market like gravity. Always there, sometimes annoying, but never something you fight. So let's walk through how the system is actually supposed to work for someone starting cold in 2026. Step 1. Pick the right container. If your job offers a 401k with any match, max that first. It's literally free money. No match? Open a Roth IRA if your income qualifies. Contributions grow tax-free forever. Otherwise, a plain taxable brokerage. The account type matters more than the first stock you pick. Step 2. Choose the vehicle that removes the guesswork. Skip individual stocks. Skip the hot crypto coin. Buy a single low-cost index fund or ETF that owns the entire US market, or the S&P 500. Vanguard's total stock market fund runs at 0.04% expense ratio. That's 4 cents per $100 per year. The fund doesn't try to beat the market, it is the market. Step 3. Automate the boring part. Set up automatic transfers from your checking account the day after payday. $50, $100, $200, whatever you can actually sustain. This is dollar cost averaging. When prices are high, you buy fewer shares. When they crash, you buy more. You never have to decide, is this a good time? The math decides for you. Step 4. Add the bare minimum guardrails. Once a year, glance at the portfolio. If you're under 40 and comfortable with swings, 90 to 100% stocks is fine. Over 40 or nervous? Slide in 10 to 20% bonds for ballast. Rebalance once a year if it drifts too far. That's it. No daily tweaks. Step 5. Leave it alone. Turn off price alerts. Mute the finance influencers. The entire edge comes from time plus compounding, not from being smarter than the next guy. That's the complete beginner playbook. 5 steps, no charts, no PhD required. Except here's where the hidden mechanics show up, and most new investors quietly quit. Take the math everyone quotes but few actually live with. Historically, the market delivers about 7% real annual return after inflation and fees. Put in $200 a month starting at age 25 and never touch it. After 40 years, you're looking at roughly $500,000. Start at 35 instead. Same $200 a month only grows to about $240,000. The difference isn't genius stock picks. It's 10 extra years of the market doing its job while you sleep. Now flip it to the version most beginners actually experience. They chase a meme stock or a 10 times AI play. They trade. They pay higher fees. They sell after a 15% drop. Studies tracking real investors show the average person underperforms the S&P by 4 to 5% a year because of bad timing alone. Over decades, that gap turns a comfortable retirement into, I'll work until I'm 70. Even worse, roughly 90% of active fund managers, the pros getting paid millions, fail to beat a simple index over 10 years. The number drops to around 80% when you stretch to 15 or 20 years. They have research teams, Bloomberg terminals, and still lose to a robot that buys everything. The irony is thick. The apps and TikToks screaming "Start investing today" make it look like a video game. Colorful charts, leaderboards, push notifications. They profit when you click buy and sell more often. The plain index fund that just sits there makes them almost nothing. So they don't push it as hard. Meanwhile, the popular hype in 2026 is the same as every year. This cycle is different. AI stocks will 10 times. Crypto is the new gold. The underlying reality is brutally consistent. Every cycle has its story. The index still owns the winners, owns the losers, and keeps marching. The people who win long-term are the ones who stop trying to guess which story is real. The uncomfortable part beginners rarely hear. Volatility isn't a bug, it's the feature. The market drops 10% or more in a calendar year almost every single year on record. Full-blown 20 to 30% crashes happen every 5 to 7 years on average. If you start investing in 2026 and hit one of those drops early, it can feel like the end of the world. But historically, the recovery has always come, sometimes in months, usually within a couple of years. There's also sequence of returns risk. If you're planning to retire in the next 10 to 15 years and a bad stretch hits right when you start pulling money out, your portfolio can shrink fast even if the long-term average is fine. That's why the boring playbook quietly adds bonds as you age. Zoom out, and the broader implications hit harder. In 2026, jobs feel less secure than ever. AI is already trimming middle layers. Wages are growing, but not fast enough to outrun lifestyle creep plus healthcare and housing. Your savings rate and emergency fund handle the short term. Investing is the only lever that can turn the long game in your favor. The real risk isn't a market crash. It's doing nothing. Cash sitting in a checking account loses 2.5% a year to inflation. That slow bleed is invisible until you need the money in 2036 and realize it buys a lot less than you thought. The people who actually build wealth in this environment aren't smarter, they aren't luckier. They just removed themselves from the decision-making process. They automated the deposits, picked the index, and went back to living their life. The market did the rest. So here's the part that stays with you after the video ends. You now know the 2026 beginner playbook. One account, one index fund, one automatic transfer. The math is ancient. The tools are cheaper and simpler than ever. The only variable left is whether you start this month with $50 or $500, or whether you keep waiting for the perfect moment that the market never actually delivers. Your future self isn't going to remember the exact price you paid on day one. They're only going to notice whether you showed up. The transfer button is right there. The market is open. What happens next is entirely up to you.